Amazon. Amazing zone. You want to talk about an easy money stock to hold for the next many years? This, I thought, would be the first perfect example of an easy money stock. If you want to build your portfolio around a stock, Amazon's definitely a contender to be one of the best stocks you could build a portfolio around in terms of a low stress stock that's going to go up almost every single year outside of like a major crash in the market or something crazy like that, right? So Amazon so far, we're up $84,000 on the stock. It's just small gains from what I believe the stock's going to go up over the coming years, okay? Now, what I'm showing you right now is the past 10 years of historical performance for Amazon stock. And what you're going to find is something very interesting here. Only one down year in the past 10 years for Amazon stock. And that was 2022, a year in which the NASDAQ got decimated from basically the peak of Q4 2021 through the trough of Q4 2022. The NASDAQ fell something like, it was around 38%, right? Very freak year for the NASDAQ to ever get hit like that. That was one of the hardest hit years we've ever seen in terms of NASDAQ. Only time period I could think bigger than that was the great financial crisis and the tech bubble. And so we had a freak situation where Amazon stock got hammered that particular year. And it was a great buying opportunity if you were buying shares like I was in the back half of 2022. But the moral of the story is one down year out of 10. But look at this. 4 of the 10 years were not just like up years. They were insane up years, right? 117% gain in 2015, 56% gain in 2017, 76% gain in 2020, 80% gain in 2023, right? And then all the other years are positive as well. So one down year out of 10 and 4 absolute banger years out of 10. I like the odds of that, right? Now, when it comes to Amazon, it was interesting. I was looking back at their 2003 annual report. Yeah, way back in 2003. And I was looking at some of their numbers they were doing back then. Remember, this is already after the tech bubble had popped. This is when people started to recognize these companies as like, oh, okay, the ones that made it through the tech bubble bursting are going to actually make it to the other side, all those sorts of things, right? I was look at Amazon's revenue in 2003. It was $5.2 billion, right? Which was a huge number, by the way, in its day. Like, that was a crazy number to be doing e-commerce wise. Massive, right? Looking at their 2023, their latest annual report, right? Check this out. Their revenue was $574 billion. They over 100x'd their revenue in that 20-year span. That is just incredible to see that, right? Now, when it comes to Amazon, here's what's interesting about this. If you look at their e-commerce market share, they're a little under 40%. Now, when it comes to their e-commerce side of the business, which is one of 3 core businesses for them, Amazon owns a ton of different businesses, but there's really 3 core businesses. The e-commerce business has a huge moat around it, and that moat is increasing. And the reason they have such a big moat around their e-commerce business, and the reason you can't really compete with it, is they have reached such a scale, and they have invested in that business for 30 years practically now, right? Almost 30 years. Non-stop. And so it's created this moat around the business where you can't compete with them when it comes to the scale of the amount of sellers and third-party sellers they have on it, right? The pricing they offer on Amazon, the delivery capabilities, right? And being able to receive your packages in a very short amount of time. They keep cutting that time down. I mean, it's very commonplace that now you can get many packages delivered within 24 hours, which is just insane, right? And they were really the first to make it, huge into like 2-day delivery. And now is a lot of things I'll order and it's like, it's here within 24 hours. I might be here at my house within 12 hours of me ordering it, which is just crazy to think about, right? And so that business has an increasing moat, and you don't have enough money to invest to be able to build out what Amazon has there. And it has a brand name of, like, everybody knows Amazon. Like, you live in any of the developed world, you know Amazon. Like, you're thinking about, I need to order a 12-pack of AA batteries. Amazon. Let me go on Amazon. Let me go on my phone real quick and order this, right? And that's just a moat you can't compete with. And so that's why their market share there is so high, and it's going to remain extraordinarily high for, honestly, probably decades to go in the future, right? Now, when it comes to AWS, this is a second of their 3 core businesses. AWS has stiff competition. And the reason being is they have to compete. In e-commerce, they were able to take over that so easily because they didn't have to compete with any big tech companies, right? All the other big tech companies, they tried little stuff here and there, but even they weren't willing to invest the way Amazon was willing to invest in e-commerce, right? And so they just kind of got out there in front of everybody by a mile. But when it comes to cloud, they have to compete against big dogs. They compete against Microsoft, which is Azure, right? They compete against Google with Google Cloud. They compete against Salesforce, IBM, Oracle. They compete against all the big tech companies. So it's a much tougher fight. And obviously the Microsoft fight is the toughest one of the bunch. But with that being said, despite that, they still have a 30% plus market share. I believe the latest quarter was around 32% market share in cloud. And so that business will end up being a very stable business, and I think it's going to be way more profitable than it even is today. Today, you look at the cloud business and you think of it as very big profits. I don't think this is really the huge profit days. I think that's coming over this next 5-10 years. And the reason being is we've been in a market share battle, right? Google's trying to get their market share, Azure is trying to get theirs, right? AWS, and so pricing can be very competitive. Think of it as Uber and Lyft back in the day, right? Uber and Lyft, when they were competing over market share, the pricing was very competitive with those two companies. Now, they're not as focused on market share. They kind of have their market shares, and now they're like, let's start making money from this business, right? And so when I look at the cloud business, I think that's what's going to transform over the next 5-10 years. I think these companies are going to get much more focused on, here's our market share, we're roughly in this range, it is what it is. We can fight over this market share and lose all profitability, or we can just focus on making money. What do we want to do? And that's where it comes in with making money, right? Now, the third core business, this is very important business, and I mean extremely important because you're talking about huge margins with this business. That is their advertising business. And their advertising business has been, honestly, just going up like a rocket ship, okay? Check this out. If we go back to 2020, Q3 of 2020, their advertising revenue was a little under $5 billion. This upcoming quarter, they're going to report likely advertising revenue of $14 billion plus dollars, somewhere around there roughly, right? Which is just extraordinary because that's in just a few years span. To go from less than $5 billion to around $14 billion likely, right? That's extraordinary. And this business is straight profit for them. Straight profit business when it comes to advertising. We know advertising is a holy grail. How do you think Meta became a $2 billion market cap and Google became so big? Advertising, right? It's so profitable. And Amazon's just making bank on advertising. And honestly, the growth rates have been extraordinary from that business overall, right? Now, what's interesting when you look at Amazon is on a forward P basis and 2-year forward P basis, this is actually trading very cheap compared to where Amazon usually trades at. Forward P at 39, 2-year forward P at 30. Keep in mind, don't be surprised if Amazon ends up being way more profitable than analysts estimate here. So maybe the 2-year forward P is like a 25, 27 here. But that's way too cheap for Amazon. This is way too cheap for Amazon, right? Now, check out the revenue, trailing 12-month revenue of Amazon over time. And tell me what companies, what area of the market does that look like? That, to me, looks like a SaaS play, does it not? Software as a service. And SaaS plays get the highest PE ratios. Many times those companies are always trading at PEs over 30. Many SaaS companies trading at PEs 35, 40, 50, 60, 70. Like, they're the holy grail business models because they're usually very sticky. They're usually B2B heavy, right? And it's just the ultimate business models, right? And you look at Amazon's revenue over time, it kind of looks like a SaaS play on a trailing 12-month basis, doesn't it? It's just stable, goes up and up and up and up and up. It's beautiful, right? Now, additionally, the company's flooded with free cash flow. Look at the trailing 12-month free cash flow in this company, right? And remember, when you're talking about free cash flow, you're taking out CapEx here. And still their free cash flow is absolutely extraordinary. Now look at their operating cash flow. Oh my gosh, they've blown this number up to way over $100 billion in operating cash flow in this company. That's crazy. Look at the operating income of this company, right? Look at the operating income. On a trailing 12-month basis, they've now done $54 billion on a trailing 12-month basis in operating income. But here's the best part. I estimate, based upon my estimates I've done for Amazon, I estimate that Amazon's going to do between $75 billion and $100 billion in operating income in the next 12-month span. In the next 12-month span. That's incredible, okay? And so keep in mind, Amazon is still somewhat early in their real profitable story. Like people weren't even thinking about Amazon as a big profit company 5-10 years ago. They're still actually kind of early days. I would call them kind of like they're in either the second inning or the third inning of their profitability cycle. Let that sink in for a moment. So when we're talking about doing $75 to $100 billion of operating income in the next 12 months, imagine where they're going to be at 5 years out, 7 years out, 10 years out when it comes to those numbers. Just ridiculous. Now, additionally, shareholder equity continues to boom for the company. Now $236 billion in shareholder equity at Amazon. That's just going to continue to go up here. Now, when it comes to Amazon, I ran some numbers here, and you can begin to understand why this company is just such an easy money stock over the coming years. My numbers are fairly conservative here. I ran them at revenue growth of 12% a year on average from 2025 to 2028. That's not crazy at all. Very doable for Amazon. 12%, right? I ran that at net income growth of 20%. Not crazy at all. That gets them to net income margins of 10% come 2028. Both those are very doable numbers. You could talk to most bullish analysts and they'll tell you, oh yeah, that's very doable numbers for Amazon over the coming years, right? You value them at somewhere between a PE of 35 to 45, which if it's Amazon growing at 12% top line, 20% bottom line on average, 35 to 45 is very fair value for the stock, right? That puts the stock price somewhere between $339 and $436. And remember, it's a $187 stock here today, right? That gives you a compounding annual growth rate around 16% on the low end and 23% on the high end for a low stress stock, an easy money stock. That's the best part. You get a great return profile, but it's like you don't have to worry about like, oh, is Amazon going to go under? Like, oh my gosh, like, whoa, is Amazon going to be disrupted by this? No, it's Amazon, man. They're just absolutely incredible company. Now they're about to report earnings here. They're one of many companies that are about to report earnings, right? So you might say, well, is this stock a buy before earnings? Absolutely, it's a buy before earnings. You might say, is it a buy after earnings? Yes, it's a buy after earnings. It doesn't matter what happens on earnings. Stock goes down to 180, buy. Stock goes up to 200, buy. It doesn't matter what happens to the stock price after earnings. It's a buy before the earnings come out. It's a buy after the earnings come out. It's just a question of, are you going to get a bigger discount after earnings? I don't know. I wouldn't necessarily bet against it, right? But also keep in mind, Amazon stock's a buy this entire decade. So also keep that in mind, right? Absolutely incredible. So Amazon absolutely is a easy money stock, low stress. You got an incredible management team in place at that company, right? And remember, Amazon does business all over the globe. So as global net worth grows, right? As countries get more successful, as you know, the middle class continues to be built up in country after country, Amazon's going to be one of the biggest direct beneficiaries of that around the globe, right? Because they are a global company. They're just about everywhere you want to be outside of really China. They really don't have much for business in China at all. But outside of China, everywhere else, net worth grows. People are doing better over time. Middle class rises in these other countries. Amazon benefits from that. It's not like a lot of times, because I live in the United States, a lot of my viewership, I think 60% of my viewers live in the United States, right? A lot of us just think about Amazon as this United States company, and it is, but they also benefit from around the globe expansion. And they've been spending aggressively outside of the United States of America and outside of Europe, right? And a lot of that spending does not pay off right now in terms of the profits, but it's meant to pay off 5 years out, 10 years out when it comes to profits, for Amazon. So just keep that in mind as well. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That is my personal advanced software that I use to make my investment decisions when I go to invest in companies. As somebody that's been in the market 15 years, I got sick and tired of using these different services that folks have out there that are designed for traders in the market. People that are looking to get in and out of stocks. That's not what I'm here to do. I'm here to long-term invest. I need to be able to see all the different ratios and metrics that are very important for me as a long-term investor to judge if I'm getting a great deal on a stock or if I'm getting ripped off on a stock. I need to be able to compare different companies versus each other and be able to do that in a matter of seconds rather than it taking hours like it used to before I created this service. I want the ability to listen to conference calls, see SEC filings all in one service. That is what we've created with 1000xstocks.com. If you are looking to access this software, go down to the description area of this video. You can click the link down there and apply for access. If you don't want to do that and you want to search a website, go to 1000xstocks.com. Enjoy it. Alrighty, guys, so let's talk some cake here at the beginning, right? Now up $26,000 plus, doesn't include dividends. Another nearly $10,000 gain here today in regards to the stock. Here's what's going on with Cake. I don't think a lot of people looked at the numbers. There's some very exciting things going on with the numbers here in regards to Cheesecake Factory. There's a reason I gave them a grade A in regards to this income statement, okay? Check this out. First off, they grew their revenue year over year $35 million. Now, that's pretty dang good considering the restaurant environment has not been good. If you've been looking at the restaurant sector as a whole in regards to restaurant sales, not good. Look at Darden Restaurants numbers. Olive Garden numbers have been negative recently over the last few quarters. Like, it has not been a good space, right? But Cheesecake still grew their revenue $35 million year over year, right? And part of that's because of Cheesecake Factory restaurant, but a lot of that has to do with North Italia and Flower Child concepts that are just ultra successful and just have an incredible opportunity over this next decade to expand. Food and beverage costs dropped significantly for the company as a percent of revenue. They dropped to 22.6% from 23.5% at the same time last year. That's phenomenal. Additionally, labor expense dropped to 35.9% from 36.3% for the company. As far as other costs, they kind of kept that in line, G&A, depreciation, amortization, those sorts of things, right? So overall, if you look at their total costs and expenses, 96.1% of revenue was in costs and expenses, but that compares to 97.7% in this same quarter last year, right? Which, keep in mind, the quarter they just reported, not usually a strong quarter. Summertime usually is kind of a little bit weaker for the restaurant industry in general, right? So they had income from operations of $33.7 million. That's 3.9% of revenue compared to 2.3% of revenue at the same point last year. Additionally, net income came in at $29.9 million. That's 3.5% net margin. Now, the restaurant industry, low margin, especially in those summertime months, but that's from 2.2% at the same time last year. So they got basically an extra $12 million of net income versus the same quarter last year, which for a $2 billion market cap's a big deal. That's phenomenal, especially in a weak quarter like that, right? Look at what happened to EPS. Diluted EPS went to 61 cents a share versus 37 cents a share in the same quarter last year, right? Which is phenomenal. So these numbers from Cheesecake were an absolute banger, and this shows you that they're running their business on a very high level. It shows you their margins are expanding in this business model, right? Which is something we all want to see. We want to see revenues going up. We want to see the net income going up, right? We want to see gross margins going up. We want to see EPS going up. This is all phenomenal, right? And that means they're going to be able to invest more money into their business to build out more North Italia locations, more Flower Childs, which is their two main concepts that just have incredible opportunity for expansion over the coming years. And plus they have their FRC concepts as well, right? So this is very, very exciting, right? Probably bigger share buybacks down the road, probably much bigger dividends down the road. They just declared another dividend. So you're going to get another 27 cents per share you own here very soon, which, as somebody that owns a lot of shares of stock, I'm very, very happy about that. It adds up to a pretty big number at the end of it, right? Now, let me also show you why this stock's going to continue to run, why it still has a lot, and I mean a lot of upside ahead, okay? When I show you Cheesecake's forward P on the stock, it's 14. Now, that would be fine if this is a company that, you know, let's say they're in some sort of situation where they're having trouble even growing their earnings per share, right? Let's say their earnings per share is going up, I don't know, 3%, 4%, 5%. You could say, okay, 14 forward P and under market multiple, right? Because market a lot of times trading at like 18 to 26 forward Ps, and they're at a 14. So you could say if their EPS is going up by like 3%, all right, like we can understand why this stock would trade under a market multiple. But the fact is, their net income's exploding for this company, right? And it's an incredible increase. What is that, that's way over a 30% increase. That's like a 40%-ish type increase in regards to net income there, right? That's an incredible number. And so they're growing maybe like 10x what a stock should be growing at in regards to their net income for a company trading at a forward P of 14. So you can begin to understand. Now, are they going to be able to have their net income go up 40% all the time, year over year? No. But when you're growing at like, let's say a 40%-ish type clip, somewhere around there roughly, right? when you start coming down, then you maybe are doing like 30% number, 20% number, 10% number. That's still significantly above where a lot of these stocks in the market are trading at, right? So Cake should minimum be trading at a forward P of 20 right now, bare minimum. But they should really be trading at a forward P more in the 25 to 30 range, which is why the stock has significantly more upside. And this is why the stock, in my opinion, is headed to 100 plus. Plus, it's a dividend payer, right? So just an incredible opportunity here. I'm already making a lot of money on it. Cake shareholders in general making a lot of money, and we love this stock, man. And it's not one you have to stress over either, right? Am I interested in buying more Cake shares after this move? Yes, of course. It's still easy money. Like, do I not like easy money? Do I not like free money? Do I not like anti-stress money? Like, of course I do. And so the bottom line is Cake is still a buy. And so you'll likely continue to see me buy shares over the coming weeks and coming months in regards to stock. If it goes to 70 plus, I'll probably dial back my buys. And then it's not as intriguing because then the risk reward is not as attractive. Doesn't mean it's still not a moneymaker, because it will still be a moneymaker even after it goes to 70 plus. It's just by that time, there's probably other opportunities that are, more attractive at that particular time, right? So Cake, easy buy and hold for the next 5-10 years. And I love those sorts of companies. I love a company where I can see the growth roadmap for the next 5 to 10 years. I don't have to stress over it. Sure, we'll go through recessions in the future. We'll have a recession, right? That will happen. And, restaurant sales will really suck for a little period of time. By the way, restaurant sales haven't been good recently. So I do think that's worth mentioning. But if we're talking about a company that I can easily see the next 5-10 years with this company, Cheesecake's that company. They got their cash, they got their ATM, which is Cheesecake Factory concept, right? And then they got their two major growth concepts. North Italia and Flower Child was going to expand all over the United States of America. And the comp restaurant sales out of those locations is ridiculous. Like, people don't understand the Flower Child concept in itself, how big that opportunity is. And then they don't even understand that North Italia is basically an Olive Garden, but like for the modern age of like much higher experience, right? A much better quality of food than Olive Garden and all those sorts of things, right? And folks don't understand like how big that opportunity is. And then they have concepts even coming behind those that are tremendous opportunities. So yeah, and the whole splitting of the company idea is a horrible idea on so many levels, right? But the main level is, if you all of a sudden split off those FRC concepts, then Cheesecake doesn't have growth. That's not going to be exciting, right? The reason I'm investing in Cheesecake is because they have an ATM. They know how to run this company phenomenal. And then they got these growth concepts coming behind it that are just very, very exciting, right? And the management team knows how to, make these restaurants very successful across all different states. And whether you go to, someplace in Charlotte, North Carolina, or whether you're in Miami, Florida, and you go to one of these locations, the experience is still phenomenal, right? But additionally, if you split off this, then you have to have a CEO of the other company, other executives of the other company, a CFO, a COO, right? Which are very high paying positions. Your G&A cost explodes higher. So then the FRC side is not going to be profitable. They're probably going to end up losing money, actually. Go from making money to then unprofitable, right? Meanwhile, you don't have that management team there in place that is phenomenal at doing what they do. So that's just crazy. Like, no. This company is on it. They're doing a tremendous job. Let them cook. Let them cook, okay? Let them cook. And that's my message to those other investors.